Environmental social governance on the irrelevance of ESG investment. Hello and welcome to this 10 minutes talk. Many people like you, like my children, they wonder, should we invest in ESG funds and are we a better person because we do so? Environmental social governance companies who adhere to these kind of criteria. Sounds good. Secures a lot of votes if you do it as a public entity, for example, like the German Social Security Authority. So let me just motivate this briefly. Our Social Security Authority takes a loan in the bond market, 10 to 12 billion euros each year in Germany, and they accumulate 200 billion euros of debt, and they want to invest it in the stock market. And because the return in the stock market is usually higher than the return in the bond market, this should finance part of their pensions. Well, so they engage in kind of hedge fund behavior. Now, the question is, does it really matter how these funds, how these money is invested, whether it's in ESG funds or not? And the Social Security Authority has promised to predominantly invest in ESG funds. And my conclusion in this talk, which will take about 10 minutes, is, well, it doesn't really matter whether they invested in ESG funds or not. This will not save the environment. This is just nice marketing so that we, the voters, are happy, or if you are an individual and invest in these ESG funds, that you feel good about yourself, but will it make a difference? Very likely not. So let me point out the economic argument. And for this, you really do not need to study economics for 3-4 years or so on. Just the basic idea that I can convey to you within 5 minutes is enough. So if you have never had a course in economics, well, you probably understand the argument. So the basic thing you need to understand here is supply and demand in a market. And we look at a particular market, capital markets here, let's say bonds or equities. So the supply is upwards sloping, meaning that the firms offer a higher quantity of equity or bonds if they receive a higher price. Makes sense, huh? If they get a lot of money, well, they win. It makes sense to invest it. The cost of investment go down. Vice versa, the demand curve for these funds, for this capital, is downward sloping, meaning that at a high price we are only willing to buy a small quantity. At a low price we are willing to buy a high quantity. And where these two curves, supply and demand, intersect, we have the point of equilibrium with the equilibrium price of the capital and the equilibrium quantity of the capital. If you understand this, well, then it's fine. Then you will understand the rest because it's trivial. So now we consider two markets. So ordinary bad companies, let's say companies who pollute the environment like Exxon or similar, and the good companies which adhere to the ESG criteria, comply with environmental social governance criteria. At least those who pretend to do this. Some, of course, engage in greenwashing, but let's assume there are really good companies out there who comply with these criteria. Now, in this market, we have, again, a supply curve, which is upward sloping, increases with the price. And now we have to distinguish two kinds of investors. Those who only invest in ESG funds, like the German pension fund here, or like my children were planning to do, but I dropped them out of it. And these are represented here by the red line and the residual demand for financial products. Now, what will happen to the residual? Well, they allocate their money to either of these two markets wherever they get a higher return. And they get a higher return in the market where there's a lower price. Well, remember that if the price goes up, return goes down. Simple example, let's say a bond. A bond with a maturity of 1 year. So in 1 year you get a face value of $100 and you buy it at $90. well, then the return is $10. If the price goes up to 95, then the return is 95. The difference to $100, $5. So the return goes down. So price and return are inversely related. When the one goes up, the other one goes down. So as an investor, as a residual investor who does not care about ESG, like I do, well, you invest where you get a higher return. And in equilibrium, then, of course, the returns must be equal in the two market. The prices must be equal in the two market. So that you allocate the residual demand to these two markets, and some of it is allocated to the ESG market, and the bigger share is allocated to ordinary firms like Excel. Now, what happens if you decide, or the German Pension Authority decides, to invest more money in the ESG market because you're a good person? Well, in this case, this part of total demand shifts outwards. More people want to invest according to the ESG criteria. And the residual demand, again, is allocated to the two markets. And wherever the return is higher, the investors will put their money in this market. So what will I do? I will look at the two markets, where's the return higher, and I pick investment in this market. And of course, in equilibrium, the two returns must be equal. Otherwise, you would benefit from shifting the market where the prices are lower. So what is the result of these extra 200 billion euros the pension authority in Germany will invest in ESG funds? Nothing, because the quantities in the two markets are still the same, prices are still the same. The only difference is that companies in this market invest a lot of money in marketing activities, a lot of money in greenwashing or whatever to persuade you to buy their products. But this is just waste of resources and the aggregate economy, because smart people who understand psychology, who understand financial markets, engage in this kind of activity and are not available elsewhere. And so this is a waste of resources. So as a consequence of this, well, the economy might even suffer because we waste resources. Now, of course, there's one exception when ESG investment will be beneficial to the environment and social governance, is when this component of total demand, ESG demand, increases above the equilibrium prices in the ordinary capital market. So for this to result, in this case, well, the residual demand is too small, residual demand would fall, and we have lower prices in the ordinary capital market and higher prices in the ESG market. So returns here are higher, but empirical evidence does not bear out this effect here. And if you consider how people mostly invest today. So for example, my children and I, what we do, we put our money in exchange traded funds, for example, BlackRock, and buy the Standard & Poor's 500 index, the MSCI World Index, and there is no ESG criteria applied to these two market indices. And this is the majority of investments. So the couple of funds that adhere with these criteria, of course, are not enough so that the red curve shifts above here. So to summarize my advice, just don't care about ESG, just invest your money where you get the highest return, and be critical of all these kind of political statements or firm statements that we help the environment, help social governments. In reality, the effect is close to zero. And perhaps it's even detrimental, negative, because it's a waste of resources for documenting all your ESG criteria.